The thesis from the Wealth Asset Allocation Committee, part of TD Asset Management, has been a preference towards equities over fixed income, and from a geographical standpoint, North America over other parts of the world. Their latest issue of Forward Perspectives has just come out, and it talks about that thesis in the context of inflation. It's called Inflation Trends, a Risk to Our Thesis. Here to tell us if inflation is a risk to the thesis, we're joined by Bruce Cooper and Ken Miner. They're both vice chairs at TD Asset Management. Nice to see you both.
Great to be here. Too.
Ken, I'm going to start with you. Let's start with just the context right now with inflation. We have two different pictures emerging in the world. North America, we're getting close to that 2%, which central bankers eye. Europe, not so much, different story. So just give us the context of what's actually happening.
Right, thanks, Kim. Well, as investors, we're really focused on protecting and growing the real value of client assets that are entrusted to us. We understand that what clients want to do is the purpose of saving today is about spending tomorrow. And they're really concerned about being able to spend at least as much tomorrow as they are today. So many people know that from the early 90s up to the financial crisis, inflation averaged about 2%. The crisis really affected economic growth, and the response by central banks was to flood the market with liquidity, and that drove interest rates down. And throughout that period, inflation was very low, lots of spare capacity. Well, in North America, we've actually seen inflation recover a little bit to around that 2%, so things are on track. But in some parts of the world, notably Europe, inflation's been low, and in fact, despite the monetary stimulus, has continued to trend lower. Mm-hmm. And so from our perspective, the thesis we have of equities over fixed income is in the context there's a band of inflation that supports that thesis. Globally, we still think we're in that band, but we think Europe definitely bears watching.
Okay. I want to come back to that in a second, but I noticed in one page on this report, you actually have a graph. You talk about this band. There's a sweet spot for inflation in terms of PEs. They seem to be doing pretty well, and then when you deviate beyond the sweet spot, they decline. So what is that, first off, and why do we see that?
Yeah, so that sweet spot is between sort of 0 and 4% inflation. Right. If you get a deflationary scenario, what we tend to see is PE ratios decline. I think what the graph shows is they can go down from the high teens in the sweet spot to the low teens in a deflationary scenario. And I think that's because the market worries in a deflationary scenario that earnings won't come through because companies don't have pricing power, and so they start to put a lower valuation on today's earnings. At the other end, when you get inflation, say 4, 5, 6% inflation, as we saw in the 70s, of course, bonds become very competitive as attractive assets with equity. So PE ratios once again start to decline when interest rates go up to reflect higher inflation. So we want to see inflation within this sweet spot in order to stay with our thesis.
Why is it unlikely, do you think, given your thesis, that inflation won't move beyond 0 and 4%? And let's start with maybe with the 0. Why aren't we going to see deflationary environment?
Yeah, if you look in North America, we think the output gap is closing, meaning we're generating jobs, growth is coming back, confidence is returning, investment is returning. So within that scenario where growth is getting better and jobs are coming back, deflation becomes less likely in North America.
And why wouldn't we see then the other side, inflation?
Yeah, there's a couple of big reasons. We've been of the view that the huge amount of debt out there in the world is a huge factor that investors need to keep in mind. And that huge amount of debt tends to be either deflationary or inhibits inflation from coming back aggressively. So that's an important factor. And the other thing is, even though jobs are coming back, unemployment is still higher than normal, certainly higher than optimal. And so there's really no wage pressure that would cause inflation to go up here. So you are in this sweet spot. No inflationary pressures, no deflationary pressures. The one thing that we do want to emphasize is within Europe, there are some deflationary forces, and that's an area we need to keep a very close eye on.
Okay, so speaking of Europe and keeping a close eye on Europe, you don't address it directly in the commentary, but the ECB has recently moved to negative deposit rates. Back up for 1 second. Explain what negative deposit rates are, because every time I see this, I just shake my head. So what are they?
As central banks have gone to a lot of monetary stimulus, they give money goes in the system, banks get money. When banks have excess amounts of money that they can't lend out, they deposit it with the central bank. And historically, central banks have paid them a small amount of interest on that, say 0.25%. What the ECB has done in an attempt to get those banks, rather than leaving it on deposit with the central bank, to deploy it and make loans, is they're actually going to charge them a fee for holding their money. So the idea here is to disincentivize the banks from putting it with the central bank and make loans. And the real question is, will that work, or will it just be a tax on banks?
Will it work, or will it just be a tax on banks?
Well, I was recently over at the Global Fixed Income Forum, which happened to be held in Lucerne in Switzerland, and there were about 60 global investors at that. And generally speaking, they were of the view within Europe that it wouldn't have, that the next stage of what the central bank in Europe could do, which is called an asset purchase program that the US Federal Reserve has been doing, where they actually buy assets from these banks, won't happen. My own view is that I think that that program will come fairly quickly. And the reason is, if you really want to incent a bank to loan, and that bank has a lot of, say, low-quality assets, if you can let them package those low-quality assets into a securitized, an asset-backed program, and sell it to the central bank, that will do two things. Not only will it give them cash, but it will give them excess capital. And when you're a bank, you just don't want excess capital, because your earnings divided by your capital gives you your return on equity. So they will want to deploy that capital much more aggressively than they would otherwise. So I'm actually of the view that you may see that in 2014 or 2015, an asset purchase program by the European Central Bank.
And given all that, so just, I guess final words from both of you. So, you've looked at inflation and basically said it's not a threat to the thesis at this point. But if we pull back and say, what are you watching that could be a threat to the thesis as you move forward?
Well, I think deflation in Europe is something we certainly are watching. And longer term, of course, valuations is something we need to care about. Equities have performed exceptionally well over the last 5 years. They're not as cheap as they were. So it's something we're very mindful of as we go along. We don't think it's a concern yet, but if they continue to perform exceptionally well, we'll keep an eye on valuations.
Great to have you both here.
Nice to be here.
Bruce Cooper, Ken Miner, Vice Chairs at TD Asset Management.